What's up, everybody? Josh Bennett here with Money Masters, the channel where we help you earn more, keep more, and grow more money. In this video, we're going to be talking about a bunch of the tech IPOs and things like that have been happening recently. So, I mean, this may come as no surprise that the IPO market and just the tech stocks in general have been insane. I mean, one of the prime examples that's out there that's in the news almost every day is Tesla, where Tesla still sort of boggles my mind. I mean, obviously, I'm probably gonna get lots of hate comments, but Tesla is a great company. Elon Musk is a genius. The cars are phenomenal, but the stock price right now makes no sense. I mean, you have a company that's valued at more than pretty much every other car company combined and makes 1/1000th of the money. That math just doesn't not add up. And then we're starting to see similar things around the IPO market that's happening right now, and it's gotten so crazy that some of the hottest tech IPOs that were supposed to happen have now been pulled while they make sense of what's going on. Roblox, the video game company, and I never know if I'm pronouncing that right, but they actually recently pulled their IPO on the tailwind of Airbnb, SnowFlake, Doordash, just because the valuation skyrocketed so much that it actually freaked them out to the point they didn't even know how to value their own company. And so this is something that we're seeing a lot, and I want to kind of dive into what's driving these, where you have these tech companies that are just hitting all-time valuations, but this is something we sort of saw in 1999 with the tech bubble, is that hype and speculation started to build on itself, and as more and more people heard, then you would start having prices driven up higher and higher and higher compared to their sales. So for example, a typical company in history has usually grown at around or been around 15 times price to earning. So basically what that means is whatever the company's valuation is, or the price of the stock is about 15 times what the company actually makes per share. So if the company's, just the stock price is $15, the company was probably making $1 per year. So just that's how you typically see the S&P 500. I mean, it can vary through times. I mean, stock markets go up, they go down, but ultimately it tends to be in that kind of 15 to 20 range. What we're seeing with Tesla, for example, Tesla is about 1,200 times earnings, so significantly higher than what we would see on average. And like DoorDash or Snowflake's about 200 times earnings, and Snowflake, for example, that company's valued at about I think it was what, $100 billion. So Snowflake's at about $100 billion in terms of valuation, which, to put that in perspective, that's around the same value as Goldman Sachs is. And Goldman Sachs pretty much runs the world. I mean, Goldman Sachs makes about $20 billion a year and is valued at $100 million, whereas Snowflake right now is making about $264 million. So they're about the same value as Goldman Sachs, with a significantly less amount of revenue and even kind of negative profits. So they're not profitable and still are as valuable as Goldman Sachs, where one could argue that Snowflake obviously has a lot of growth potential, but that doesn't necessarily make up for where the valuation is today. A lot of times people get confused by the fact that stock prices don't always necessarily mirror the companies themselves. And right now is one of those situations where the stock prices are up here and the companies may be on a much slower trajectory. Still growing quickly, but just growing hundreds or thousands of percents per year is just not realistic for companies to sustain. So that's what we're seeing with Snowflake and Tesla, is that they're just and also DoorDash, Airbnb. Like Airbnb right now is valued more than Marriott and a lot of the traditional hotel companies. Obviously, again, there's a lot of growth there, but this is coming on the tail of Airbnb losing significant money through COVID. The hope and speculation is that they'll recover and continue to grow, but we're still seeing kind of insane valuations compared to where the stock prices and the kind of what the companies would warrant today. And a lot of what's driving this is, since COVID started, there's been a drastic increase in retail trading, meaning you have sort of people at home that are bored that have now picking up on stock trading in their part time or their spare time, and which is totally an acceptable thing to do. But what tends to happen is you have people that don't necessarily know how to value the markets or how to value companies just getting bought into the hype, and that drives it in. And that's kind of what we saw in 1999 was people started hearing about the hot startups like pet.com and things like that, and then got too caught up, started wagering more and more money. They started doing things like taking out home equity to buy stocks, and ultimately it ended up really bad for all families, or not all families, but a significant portion of the U.S. economy took a huge hit because of overspeculation. And this is something we've seen all throughout history. The stories of financial bubbles go back well into like the 1500s or beyond. Again, it can happen with anything. There's no necessarily indication of what's going to kind of cause that mania. Anyone that was alive 15 years ago remembers the Beanie Baby craze. Beanie Babies were just stuffed animals, and yet would be traded for thousands and thousands of dollars. So these things happen, but it's one of those things that when you're buying your stocks, the growth and the values of the companies that are out there right now, regardless of how they are as companies, again, stock prices are very different than where they're a quality company. But you don't want to get in a position where you're buying a company because you think it's a good company without understanding how the valuation works. Because if you could be buying into a company that is significantly overvalued, even though it's a wonderful company, and that can really hurt you financially. And so you really want to know, what is the future growth of this company? Is what's being priced into the stock sustainable? If not, maybe I should do something a little more conservative, like maybe even like invest in like an index fund or something like that, instead of just investing in the hot tech startup. So hopefully you found this video valuable. Just something to kind of look at is all these tech startups are great companies, great ideas, but really understand where the valuation is, and is this logical? Walking into buying a stock, if I saw that SnowFlake, which is a fraction of the size of Goldman Sachs, was the same value, that puts up some red flags in my book. Again, SnowFlake, great company, but that still puts up red flags in my book for where that company should be valued today. And definitely take a look at all your stocks and kind of review if that's the case for you. Hope you found this valuable. Make sure you like and subscribe and get more valuable tips. Cheers.